June's job report ignites market reactions. Is a rate cut off the table? The employment figures for June have taken many by surprise, suggesting that the labor market in the United States remains robust and casting doubts on whether the Federal Reserve will reduce interest rates this month. According to a report from the Labor Department, the US economy added an impressive 147,000 jobs in June, surpassing the Wall Street Journal's expected increase of 110,000 jobs. This stronger than anticipated report also revealed that the unemployment rate dropped slightly to 4.1%, down from 4.2% in the previous month. So, what sectors contributed to this growth? Healthcare continues to be a key driver, maintaining its historical stability and proving its resilience through various economic conditions. Moreover, state and local government positions expanded significantly, even as the federal government employment saw a slight reduction, ultimately resulting in a 73,000 job increase in overall government employment. But here's where it gets interesting. The revisions to previous months revealed that even more jobs were added than first reported. April and May's job gains were revised upward by a combined 16,000 jobs. This positive news echoes the remarks of White House Press Secretary Karoline Leavitt, who highlighted the successful job creation trend, a notable point for a fourth consecutive month of surpassing market expectations. On a more controversial note, the administration's policies regarding undocumented migrants appear to have reshaped the landscape of the job market. According to the Bureau of Labor Statistics, there's been a notable shift where American-born workers have seen a growth of 2.1 million jobs from February to June, while employment among foreign-born workers dropped significantly by over 500,000. This marks the most pronounced decrease in foreign-born employment since at least the early stage of President Barack Obama's administration. Wall Street responded positively to the data, with the Dow Jones Industrial Average climbing 344 points, nearing its historic peak. The S&P 500 and the Nasdaq continued their strong performances, reaching new milestones. So, what does this mean for the Federal Reserve's interest rate decisions? Many analysts had previously expected a rate cut soon, but the latest figures might alter those plans. Chris Zaccarelli, Chief Investment Officer for Northlake Asset Management, believes that stronger job numbers combined with sustained tax cuts and potential tariff increases make the likelihood of an interest rate cut much less probable in the near term. In fact, the Fed may indeed keep rates steady until later in the year. This development could stir some debate. For example, President Trump's criticism of the Treasury from further news has highlighted his dissatisfaction with Powell's cautious approach to reducing interest rates. Trump argues that rates should already be lower to support economic growth, a situation he'd like to see changed as he promotes rapid deregulation and domestic energy production. As the Fed seemingly takes the cautious approach, the focus of investors is shifting from wide-ranging economic concerns to more immediate company earnings. While it's encouraging to see the stock market's strong recovery, Zaccarelli warns that current stock valuations are high, potentially exposing investors to greater risks from unforeseen downturns, as much of the positive news may already be reflected in stock prices. What do you think about the current stance on interest rates? Do you agree that a cautious approach is better for long-term stability? Share your thoughts in the comments.